So what is a loan estimate? Because securing a pre-approval for a mortgage is a critical first step, but it's equally crucial to know how to assess the different mortgage rates available to you. A tool that can assist you in this process is called a loan estimate. When you're in the process of seeking a loan, each lender you approach should provide you with a loan estimate. These projections will be beneficial in determining which loan suits you the best. We'll go through the process of evaluating rates step by step, highlighting what's important. So what is a loan estimate? Well, it's an official document provided by a lender that gives you key details about your potential loan. These details include contact information of the lender, the projected interest rate, loan expenses, closing fees, and other costs tied to buying a home. The Consumer Financial Protection Bureau, or CFPB, which is a U.S. government regulatory agency that sets our rules and guidelines, provides this standard 3-page document, which again is called a loan estimate, or LE for short. Below is a direct link to the CFPB's website with an example of what a loan estimate should look like. So by the end of this video, you're going to be armed with all of this information, and it will be very easy for you to evaluate rates from various lenders. So what information do you need to provide the lender in order for them to provide you with an official loan estimate? Well, first off, you got to provide your full name, your income, your social security number, the address of the property, the approximate value of the property, and the loan amount. In addition, if you want a more in-depth estimate from your loan officer, you could also provide additional information such as your existing debts, the specific type of loan you are looking for, and the amount that you plan to put down. The following is an example of a loan estimate that everyone can access. This example can be found on the CFPB website. The link is in the description. Pro tip, prior to diving into the loan estimate, make sure that the loan estimate looks like the example as shown. If it does not look like the one shown here, ask your lender to supply you with an official loan estimate. By law, it needs to be provided to you within 3 days. So let's break down this loan estimate. And we can start at the top of page 1, which should have your basic information, as well as the bank name and the property address that you're interested in buying. To the right of this, there's the loan term, which indicates the duration it will take for you to repay this loan. Generally, the loan term will be between 15 to 30 years. And here's what each of the items signifies. Let's start with the loan term, a period over which the loan will be repaid with regular monthly payments. Next is purpose, what the loan will be used for. Is it to buy a home or to refinance or to cash out refinance? Next is product. It indicates whether the loan has a fixed or an adjustable rate. Next, we have loan type. So this is the kind of loan being used, whether it's a VA, an FHA, or a conventional. Next is loan ID or loan number, and it's simply a reference number used by the lender. Next, very important, is rate lock, whether the interest rate has been secured and locked or if it's still subject to daily market fluctuations. Next is loan amount. This is the amount that you're borrowing or the amount you're pre-approved for. Next is interest rate. This is the amount of interest rate you pay to the lender on this loan. Next is monthly principal and interest. This is your mortgage payment, excluding any property taxes or insurance. Below that, we have prepayment penalty, and it basically indicates whether there is a fee for paying off your loan early or not. Next is balloon payment, and this just indicates whether there will be a remaining amount to be paid at the end of the loan term. Next is projected payments. This section is divided into 2 parts, years 1 through 7 and years 8 through 30. And this is due to potential variations based on the presence or absence of mortgage insurance. Now let's review some of the terms in this section, starting with the principal. And this represents the portion of your monthly payment that goes towards paying down your loan balance. Next, we have interest, and this represents the portion that goes towards paying interest fees to the lender. Next is mortgage insurance, and this is a monthly payment that allows buyers to purchase a home without putting 20% down. And next is estimated taxes, insurance, and assessments, and this is to cover property taxes, homeowners insurance, and any HOA dues. Now, the payment structure is broken down into estimated monthly payments, including the mortgage insurance of in this case, $82. And this fee is payable every month until you accumulate 20% equity or 80% loan to value. In this case, that would be the duration of 7 years. Then the total payments for year 1 through 7 and 8 through 30 are displayed. Next is closing costs. And these are estimated closing costs, and cash to close corresponds to the total listed on page 2, which we'll get to in a bit. The estimated cash to close total indicates the amount of money you will need at the time of closing on your home. This covers your lender fees, third-party charges, and down payment. Pro tip, most of page 1 is just an estimate. As we proceed, I'm going to highlight what is truly important. Page 1, it is important, but it's not crucial. Let's move on to page 2. And page 2 provides a detailed breakdown of all closing costs and prepaids. Let's begin at the top left, section A, origination charges. Now, this is the first segment of loan cost, and under this heading are your origination charges, which is the most crucial section of this entire form. Origination charges are merged with points, application fee, and underwriting fee. Now, different lenders may use different names for these origination charges. In this case, points refers to an origination fee charged as a percentage of the loan amount. Sometimes you will see a negative figure here termed a lender credit, and this credit pertains to what the lender receives to assist in covering closing costs. Second is application fee, and this is a charge related to the processing of your mortgage loan, and this will vary based on the lender. Next is underwriting fee, and this fee covers the cost of verifying the financial information needed for your mortgage. Remember, this section is controlled by the lender. Some lenders itemize a dozen different fees, while others bundle everything into one single line item. Another term you might come across is origination or origination fee, which is a fee levied by the mortgage lender for the processing of your loan. The main figure you should focus on here is a highlighted field in bold at the top of the section. Let's move on to the next section of loan costs, which is B, services you cannot shop for. These are services that lenders provide for you. These include the appraisal fee, credit report fee, flood determination fee, flood monitoring fee, tax monitoring fee, and tax status research fee, and I believe that's it. Now, here's what they all mean. Appraisal fee is the cost paid to the home appraiser. That's pretty simple. Credit report fee is the cost to obtain your credit report. Next is flood determination fee, and this is for determining whether the home is in a flood zone or not. Next is the tax monitoring fee, and this is for keeping an eye on the tax account, ensuring that relevant parties are informed in case of any unpaid taxes. Next, we have tax status research fee, and this is to confirm the annual amount and ensuring that the property taxes are paid punctually. And given that you cannot shop for these services and they're provided to you by the lender, the key number to look out for is the one highlighted in bold at the top of section B. Now let's move on to the next section of loan costs, which is C, services you can shop for. Now these costs can differ among lenders based on how they calculate these fees for you. Most are straightforward, but let's quickly go over them here. First up is the pest inspection fee, and this is for examining the home for any hard to detect pests like termites. Next, we have a survey fee, and this to verify that the property boundaries match what is recorded with the county. Next is title insurance, and this is a type of real estate insurance that covers the transfer of ownership. Next, we have lender's title policy, and this is a safeguard to the lender against any future title disputes. Next, we have the settlement agent fee, and this is a fee for the escrow or closing agent who manages and distributes all the documents and the money from the buyer and the seller in the transaction. Next, we have title search, and this is to investigate and verify that the property legally belongs to the owner and that they have the right to sell it to you. This becomes significant when comparing quotes if the total number varies substantially. If the differences are small, don't stress. Now, section D here are the total loan costs. This section pretty much sums up or adds up sections A, B, and C. Now, let's move on to other costs, or section E, and this is taxes and other government fees. Let's start with recording fees and other taxes. And this is pretty straightforward. This is money that is paid to the county to register the sale as a public record. Next, we have transfer tax, and these are paid to the county for the transfer of the deed from seller to buyer. The key point on this is that no matter who your lender is, these costs will remain exactly the same when you close. Section F here is the prepaid section, and this covers all of your prepaid. These are estimated costs that you need to pay upfront, and they include homeowner insurance, which refers to the number of months worth of homeowner's insurance payments due upfront. That's typically 12 months. Then you have mortgage insurance premiums, and this refers to the number of months worth of mortgage insurance premium due upfront. Then you got prepaid interest, and this is the amount of interest due upfront for the number of days from closing up until the end of the month. And then finally, we have property taxes, and this refers to the number of months worth of property taxes due upfront. Again, don't be overly concerned about the precise dollar amount in this section because these are merely estimates and will differ among the lenders. Let's move on to section G, and this is initial escrow payment at closing. This section details the money due at closing, similar to the prepaids in the previous section. However, these differ from the prepaids because they go towards setting up an escrow account, which allows you to make these payments monthly as part of your mortgage payment. Escrow accounts prevent sudden large payments and facilitate easy budgeting. Some of the items you'll find in this section include homeowner's insurance, which covers the home and its contents against unexpected damage. Flood insurance, which is separate from homeowner's insurance, will also be in this section. Mortgage insurance, which facilitates the purchase of a home with a down payment of less than 20%. And then you got property taxes, which you pay to the county for the home ownership. And next we have section H, or other. And this houses costs that don't fit into any of the other sections. And this includes title fees such as owner's title policy. And an owner's title policy safeguards the buyer against any future title disputes. For example, let's say that the seller hired a contractor to redo the driveway and did not pay him. So that contractor may file a lien against that home, and this insurance protects you from that. So in regards to these sections, when comparing quotes, ensure that the numbers are similar. They don't have to be exact because these are just estimates. At closing, all the costs will be identical regardless of your lender. So this isn't anything you can negotiate, and they're all going to be the same, again, regardless of the lender. Next, we have section J, which is the total closing cost. And this pretty much sums everything up and then subtracts any lender credits that you may receive. Let's move down to the cash to close section, and calculating cash to close will vary for every transaction. These vary depending on the earnest money deposit you have or have not placed into escrow. This section gives you an idea of the total amount of money you will need to pay out of pocket, including your down payment when buying a home. Pro tip: do not get overly focused on estimated figures. It's beneficial to have a rough idea of how much money it will take to buy a home, but when comparing lenders, these estimates are not that crucial. Let's move on to page 3. And upon arriving at the third page, you'll find more details about the lender. This page offers detailed information about the name of the mortgage lender, their licensing credentials, and how to get in touch with them. Next, we have the comparison section, and you're shown 3 items here, each with a pretty straightforward explanation. The first one is in the 5 years. This figure represents a total amount you will have paid in principal, interest, mortgage insurance, and the loan costs after 5 years, and as well as the remaining principal balance. Next, we have the APR, or the annual percentage rate, and it's the overall cost of your loan over its term expressed as a rate. Remember that this is different from your interest rate. Then you have total interest percentage, which is the full amount of interest you will pay over the loan term, expressed as a percentage of your loan amount. Although named as a comparison section, keep in mind these figures are estimations and might not be the best tools for comparing different loan offers. If you really need to choose a field for comparison, the in 5 years field is probably the most straightforward and provides a reasonable gauge. Next section is titled Other Considerations, and this includes specific information relevant to the loan. This section may vary depending on the loan type or the size of your down payment. Now, here's what each item in this example refers to. Appraisals. Now, these are necessary to establish the value of your home and are required for any home purchase. Assumption. This lets a lender state whether or not this loan, including its terms, can be transferred to another person if you decide to sell the property. Next is homeowner's insurance, and usually is required when purchasing a home to protect the house and its contents from unexpected events. Then you have late payment. This is similar to a utility bill. If you don't pay on time, you will incur a late fee, and the exact fees may differ from what you see in this example. Next is refinance, and this is the process of swapping your current mortgage loan for a new one. Various factors can affect your eligibility for a refinance, such as market instability, property value changes, or changes in your financial situation. Next, we have servicing, and this is the process of managing your loan payments. In this example, there are checkboxes that allow the lender to either service the loan themselves or transfer the servicing to a third party. So when you hear that my loan is sold, the loan is not sold, it's the servicing that gets sold. Now let's review this loan estimate example and let's highlight what to look out for. In every loan estimate, there are certain aspects that you need to keep an eye on. It's crucial to ensure that your loan estimate aligns with the format used by the CFPB, or the Consumer Finance Protection Agency. Remember, these are just estimates, so they may change. Because these are estimates, be cautious of the following. 1. Lenders might underestimate. Some lenders may not prioritize the borrower's best interest, and these lenders might deliberately underestimate costs, especially those related to taxes, insurance, and mortgage insurance. Underestimating these costs can make their quote appear much better than it will at the time of closing. On the other hand, some lenders might intentionally overestimate these costs, expecting you to negotiate for lower ones. This way, when the loan reaches the closing, they can seem like a hero by offering some good news. Both of these practices are problematic for comparison shopping, and even worse for your budgeting. You want accurate figures. Remember that the numbers are never exact up front, so don't stress about any estimated fees that your lender does not control. When comparing mortgage loan estimates, focus on the top left section of the second page of the loan estimate, as this is the area that the lender controls. The total amount of origination charges and the services that you cannot shop for are what matter, and not how they are itemized or what the lender labels them as. For example, here you have a $1,802 in origination charges and $672 in services you cannot shop for. Then the total of $2,474 is what the lender is charging to give you the rate of 3.875. This rate is listed at the top of the first page in the loan terms section. It is possible to have a 0 in loan costs, but this would likely result in a higher interest rate. On the other hand, you can also pay more upfront for a lower interest rate and a lower monthly payment. The decision is ultimately up to you based on your goals and preferences. As I conclude this presentation, it is crucial to be a well-informed and prepared homebuyer. To understand a loan estimate, focus on the most crucial variables, and that's going to be the loan costs, the interest rate, and whether the rate is locked or not, and making sure that the loan estimate is in a CFPB prescribed format. By focusing on these elements, the loan estimate becomes a lot easier to read, and you can make a confident decision when working with your lender. And remember, if you have any questions, don't hesitate to ask your lender. Do it. They should be able to answer all of your questions.